Now what we're going to do is we are actually going to apply all of those tools that we discussed and all of the principles that we follow and the discipline, and we are going to use real-time market scenarios to discuss those. And I think we're going to have a lot of ideas. Now, those ideas, guys, are not buy and sell recommendations. This is not any kind of advice. This is strictly for informational purposes, educational purposes. So make sure that you speak to your financial advisor before you do anything that regarding the things that we discuss. Or obviously, a lot of you guys are professionals, right? Traders at hedge funds, mutual funds, family offices, and whatnot. A lot of advisors. Just make sure compliance is cool with you doing some of the things that we're talking about here today. So let's just go over the top-down approach one more time. I know I discussed it earlier, but essentially what it is, for those of you who missed it, is we are first trying to look at the world from the moon, right? If we're just standing on the moon, what does Earth look like altogether? It's all of the countries. United States stocks are not up because of what's happening in the United States. United States stocks are up despite of what's happening in the United States, because stocks all over the world are up, right? It's not just America, and we're gonna get into that, and we're gonna look at that, and it's part of a bigger theme of risk appetite towards equities and growth, really. And once we figure out where the strength is and what types of countries are doing well and all those things, then we're going to dive down into the individual sectors themselves: technology, financials, healthcare, energy, and try to really isolate where the strength is and where the weakness is, and things like utilities and real estate investment trusts that have been very weak, not just on an absolute basis, but on a relative basis as well. Then the individual industries within the sectors, the subsectors, if you will. So like if we're looking at energy, for example, well, where in energy? The integrateds or the drillers or the refiners, right? So it's not just a broad picture. We could look at energy as a group, but then we need to break down energy into different industries. For example, if we're looking at something like healthcare, are we talking about the medical equipment stocks, or are we talking about the pharma or the biotechnology? Where within healthcare specifically, or are we looking at them all together? And then finally, once we identify what sectors and industry groups we want to be in, and what types of countries and assets we want to own, then we break it down to the individual stock level and then say, well, we really like stocks in the United States, and we really like financials. And then particularly within financials, we really like broker-dealers. And then within broker-dealers, Goldman Sachs looks great, and so does JP Morgan. So those are two good trades that we could put on, So it's all about the top-down approach, in my opinion, to make sure that we have the wind at our back. So the first thing that we're going to do is we're going to go over all of the country indexes all over the world, both the developed markets and the emerging markets, London and everything in Europe, of course, Latin America, Asia, both, again, developed and emerging. So while we're going to be looking at Korea and Russia, in the emerging market side, we'll also be looking at things like Singapore and Hong Kong on the developed side, and Australia. So here's all of them, and notice how everything we look at is both on a weekly and daily time frame. So members of All-Star Charts Premium get access to all of these charts that you're going to see today, and basically this is just a snapshot of the chart book, the international workbook specifically, and then you can click on any of these and it takes you directly to that chart with the comments. So what I'm trying to do, Arun spoke about, always learning and always trying to get better. I'm trying to do the same thing and learn from investors around the world. I just got back from India a couple of weeks ago. Here's me with a bunch of my new friends in India and some of the delicious food that we were eating. Here I was visiting some traders. These are the biggest traders in India at Edelweiss, and these guys just walking me around, asking me for advice. It was fantastic. I gave a presentation at Bloomberg in Mumbai, and we had 150 people there. The excitement for technical analysis was out of control. I've never seen anything like it. Here's my buddy Brijesh. Brijesh rides his motorcycle 2.5 hours a day to work, and then 2.5 hours back in not exactly the best roads. So talk about somebody who loves the market and loves technical analysis. It was so great to see that. And then here's us late night eating pizza and at the Bloomberg offices. Just kind of, these are just a bunch of traders and investors just sitting back talking about markets. I mean, it was really a fantastic sort of thing. So I encourage all of you, get out of your shell if you have that opportunity, and speak to investors that are not 3 blocks from you in Long Island, or down the road in Ohio, or whatever it is, but are really from the other side of the world, and it really is amazing the perspectives that you learn. So I just wanted to throw that out there towards you and share it with you. So let's dive right in. So, you know, I find it so difficult for the last couple of years, I feel like, to not start my presentations with the FTSE 100. I mean, you guys that have been watching my presentations for years know this. You know, probably chuckle at this point. How dare you see with the FTSE again? But I got to tell you, you know, the fact that the FTSE 100 is coming out of a 20-year base it makes it impossible for me to be bearish of stocks. I mean, that has, quite frankly, I still laugh because I've said this so many times, but one of the things that has kept me so bullish the last 2 years, just like buy everything, shut up, who cares who the president is, but Brexit, Ebola, whatever nonsense they're making up to justify the price moves of the day, oh my God, throw it away and just buy stocks, sell bonds, sell gold, sell everything, buy stocks, right? And I promise you that a big part of that consistently has been the fact that if one of the most important stock market indexes in the world is breaking out of a multi-decade base, I can't be short stocks with a straight face. I really can't. We need to be buying stocks. That's the bottom line. So I think this shows that. I think we're going to 8120 in the FTSE 100. Notice how we looked at a weekly chart to get structural perspective, and now we're looking at a daily chart to get more tactical sort of perspective. So I think we're going higher in the FTSE 100. It doesn't mean that you need to go out and buy FTSE 100 futures or you need to buy an ETF that tracks the FTSE 100. That's not the point. The point is, if one of the most important 5 indexes in the world, maybe even top 3, is breaking out of a multi-decade base, I mean, come on, we got to be buying stocks. So speaking of important markets, here's Germany. I mean, this is, you know, again, one of the most important stock markets in the world, not in a downtrend, guys, you know, coming out of a multi-year base. Nice little, you know, I believe it was Mark Newton earlier talked about a cup and handle pattern, right? This seems to be that, you know, breaking out of the former highs above 2015, consolidating, and now breaking out again. I think we go to 14,600 in the German DAX. So here's Belgium, guys. I think I mislabeled this last one. I think I mislabeled it. This is France, not FTSE 100, so scratch that. This is France. And again, very similar to Germany. This is the CAC 40 in France, breaking out above the 2015 highs, consolidating, and now breaking out towards 6,100. I think the French CAC, again, not the FTSE 100, but the CAC in France is going a lot higher, 6,100. And if Germany and France and UK are going up, that's probably not happening in an environment where US stocks are getting killed. So the Belgium 20 has been another fantastic indicator for me. You know, again, not because I'm buying stocks in Belgium, but very simply, if, you know, Belgium is coming out of a multi-year base, this is a more, you know, this isn't Germany, you know, this is a little bit not as conservative. And the fact that we are breaking out of a multi-year base to start last year, to me, was evidence of risk appetite for European equities. And if European equities are rallying, that's probably not happening in an environment where stocks all over the world are falling. They're probably going up in a synchronized way. So our initial target in the Belgium 20 was right, was hit in the second half of last year and really consolidated near that 4,700 level, right? That's the 161.8% extension. You guys who are asking me, where do you start, where do you end? Well, you start at the top of the consolidation and you end at the bottom of the consolidation. And then once we exceed those former highs, 100% retracement would be back to the highs. So 161.8% of that would be right here where we consolidated, and now we are breaking out again. So the idea has been, if we are above that 4750 level in the Belgium 20, we need to be very bullish of European equities. And that's the bottom line until it gets to 55.55, which is the next extension and where I think we're going. So from a risk management standpoint, I think Switzerland is an interesting one to watch. You know, throughout the presentation, you're going to notice that I'm going to tell you things that I think are going to happen, and then I'm going to tell you things that I think should happen if we are correct in our major theses, and what I think would happen in the case that we are wrong and we need to, a more defensive posture would perhaps be best, and not this just shut up and buy everything sort of mentality that we've really had for such a consistent amount of time. So Switzerland, in my opinion, because of its laggard status, notice how we're not above the 2015 highs yet, like we are in Germany, like we are in France, right? Like we are obviously in Belgium, here in Switzerland, we're still not above that. So that's a big problem. So we want to see this resolve higher. We don't want to see this failing, with momentum failing to get overbought here. That would be evidence of deterioration in the European equities market, and that's not really an environment where we want to be very aggressively long. We would in fact prefer to approach the market from a much more neutral perspective, or even bearish in that sort of scenario. So we want to start to see Switzerland really start to outperform here. Look at this base in Denmark. I think going very, behind the scenes. I don't think anybody's talking about Denmark breaking out here potentially of a multi-year base within the context of an uptrend. You guys talk about Fibonacci, right? So here's the highs in 2007. Here's the lows in 2009. Once we exceeded that, the next target was right here around 700. We hit that level. We consolidated for a long, long time here, right? A full year and change. And then we broke out, and the next level was right around 1,000. And that was hit as well. And then we have been consolidating ever since. So upon a breakout, this multi-year breakout, I mean, look how long it took to digest all of those gains right at that Fibonacci extension over the last several years. As we break out above the 2015 highs, I think it's evidence of accumulation for European equities, and I think that's bullish for stocks. So here's a shorter term look at that. Here's the 2015 highs. So Switzerland and Denmark, really two key areas that we are looking at for risk management purposes. If Denmark starts to fall down here as opposed to breaking out up here, that's a big problem, I think, and it would be the beginning of evidence of distribution rather than all of the accumulation that we've seen. So look, here's Italy, here's the Italian, the Milano Borsa, and we are pushing up against that 24,500, 25,000 level. And man, the more times the level is tested, the higher the likelihood that it breaks. That's the way I learned it. We have a third straight bullish divergence in momentum. We were talking about momentum in my earlier presentation. Look at the low, the new lows in price, and then look at the higher lows in RSI, leading to a rally. Look at the new lows in 2012 in Italy and the higher lows in momentum leading to a rally. And then we had the same thing here, right? New lows in price, higher low in momentum led to a rally. I think that we could potentially break out above this, and the next level would be 32,000 based on the 61.8% retracement of the entire decline from the peak in 2007 down to the bottom in 2009, which was really retested in 2012, right? So that entire thing, notice how we have consistently been stuck below that 38.2% retracement. That's the reason that we look at these levels. So being able to rally through that and break out, I think would be extremely constructive for European equities, and therefore super bullish for stocks. And I do think we get through. Is it going to happen tomorrow and we just get through and rip and go? I don't think so. I think it might take a little bit, but it'd be really interesting to see how long it takes. But once we're above it, I think that's a green light to really step on the gas long side in terms of European equities. And then listen, guys, if stocks are going to get crushed, European banks are not going to be rallying and making new multi-year highs. All right, I mean that's really the main idea here. So the fact that we are breaking out of a 8-month base in European banks to new multi-year highs is not evidence of risk aversion for equities. It is evidence of risk appetite. Momentum's in a bullish range. What do hedge funds, what do these traders want? The institutions, what are they looking for? They're looking for two things. They're looking for relative strength, and they're looking for momentum. So if some of the most riskiest or best gauges for risk appetite are showing both relative strength and momentum, come on, it's not evidence that there's distribution out there from the institutions. It's evidence of accumulation as far as I'm concerned. And then here we're seeing European banks relative to the Euro Stoxx 50, which is the Dow Jones Industrial Average of Europe, making multi-year highs. So not only are European banks going up on an absolute basis, they're going up on a relative basis too. Again, further evidence of risk appetite for sure. And then here, this is European stocks, the Euro Stoxx 50, but priced in US dollars. So taking the euro out of the equation, and I see the more times the level is tested, the higher the likelihood that it breaks. Test number one, let me get this little pointer. Test number one, test number two, test number three, and now I think we're off to the races. And I believe it was Dan Russo earlier who was saying, or Todd Stone, man, I forget, so many presentations. One of them was saying how they just can't see the the rally, the equities rally in this particular cycle coming to an end before European stocks break out. And I think that this particular chart, I think, speaks to that. So moving over to developed markets out in Asia, here's Singapore breaking out to a new high, finally above the 2015 high. So speaking of risk management sort of gauges, where we talked about Denmark, and we also spoke about Switzerland in terms of what we're going to see in terms of are they going to start to fall and lead European equities lower, or are they going to start to rally? I think you could probably throw in Singapore in there as well. If this breakout fails above those former highs, I think that would be a problem. I'm not necessarily saying that's going to happen. In fact, to the contrary, I'm in the camp that we continue higher. We go above 4,000 in Singapore. And then on the emerging side, Korea, I mean, not a downtrend, right? You know, just breaking out, consolidating, breaking out, consolidating, breaking out, momentum in a bullish range. Like, these are all characteristics of an uptrend. We haven't hit our upside objective, which at this point would be 362. By the way, guys, you know, something that's really interesting, speaking of Fibonacci that I hadn't mentioned, you know, a lot of times these Fibonacci extensions don't serve as that much resistance, but actually serve as more important support on the way down. This is actually a good example. Notice how we hit this extension. Sure, we acknowledged it and consolidated for a while in a very frustratingly tight range before ripping higher, but notice how it wound up turning into support, like very key support. So I think that's really the more interesting part, and we see that a lot in Fibonacci. So I think we're going to 362, and the way that I think we could play it here, here's the South Korea Exchange Traded Fund, EWY. If we're above 75, that means we're above the '07 highs. We want to be long and strong South Korea. Note that this is a lot of Samsung. Just keep that in the back of your mind if that means anything to you. But I think that if we're above 75, I think we can go to 110. That's a long ways away. So do the math. I think risk management is very easy here. Again, we only want to be long if we're above 75. And then look at Philippines, guys. You know, if the world was coming to an end, Philippines wouldn't be breaking out of multi-year basis to new 52-week highs. You know what I mean? Like, things like the Philippines would be breaking down, leading us lower. You know, this is Philippines breaking out of multi-year basis within a massive uptrend is not evidence of distribution. It is evidence of further accumulation, you know, especially with momentum in a bullish range. Here's a shorter term look. So, you know, here's the 2015 highs. We broke out, we retested. I mean, guys, this is as clean of a chart as you're ever going to find. And we have not reached our upside objectives, which would be right above 9,400. So here's a closer look at the Philippine Stock Exchange. Excuse me, this is not the Philippine Stock Exchange. I screwed that up again. Jeez, JC. Not on my game. This is actually China, excuse me. So this is the FXI China. And here's the former highs in 2015. And we are now breaking out above that. So sorry about this. This is FXI. And if we're above 53 in FXI, we want to be long. I think we're going to 68. And the Taiwan Stock Exchange breaking out of a base that's been building since the mid-90s. Just ask yourself that for a second. You know, if things were so bad and the world is coming to an end, meanwhile it's the most peaceful time ever and unemployment's at the lowest ever, the economy's great, so I don't know why everyone was so angry. But the world has never been a better place, and I think that looking at charts like the Philippines, breaking out of multi-year basis, looking at chart of FTSE in London breaking out of 20-year basis, Taiwan breaking out of, you know, 20+ year basis here, I think to me is huge, significant evidence that real money is being put to work around the world, and I think we need to be very long stocks. I've been saying that for a long time. I'm not just saying that since yesterday. I continue to think that we need to be buying weakness, not selling strength. I think we're going a lot higher. I think we got another 40% of upside in Taiwan. And if Taiwan's going up 40%, you think that's happening in an environment where U.S. stocks are getting killed? No. So here's Thailand, another great example, breaking out above the former highs from 20+ years ago. And I think that we're going a lot higher in Thailand. If we're above those former highs from the early 90s, we need to be finding ways to be either long Thailand or just using that as evidence to be long emerging markets, particularly in Southeast Asia. So here's Brazil, another very important market tied particularly to natural resources, which has been a big theme for me. You know, Dan was joking, my theme has been rocks and stocks. You know, I like the gold and the base metals, but I also like equities. You know, that's been my theme since December, and I firmly think that we should continue with that theme. So Brazil is right with that, you know, rocks and stocks sort of theme with their exposure to natural resources and energy and things like that. So, you know, look at the peak in 2008, look at the highs right here in 2011. You know, we broke out above that, successfully retested, and now we're off to the races. So I think we're going above 100,000 in the Bovespa, you know, so we're talking 17%, something like that. You know, that's not nothing. So I think that, you know, we need to be buying weakness in Brazil. Specifically, look at something like an EWZ as an ETF. South Korea, this is price in Rand, continues to make new highs. Look at these multi-year bases. These are huge bases. So these are not, you know, old markets that are long in the tooth or whatever that even means. What does it even mean, long in the tooth? I keep hearing that about the market. But when you see things like that breaking out of multi-year bases, you know, it's kind of hard to think anything is long in any sort of tooth. So here's Turkey. Look at the Istanbul 100. Look at this breaking out of this massive base, hitting that target of just above 113,000, and now breaking out again. So the fact that the next target is above 145,000 in Istanbul, I just don't see a country like this rallying to that extent in an environment where stocks are getting clobbered. To the contrary, that is just pure, unadulterated evidence of accumulation in equities. Egypt, hello, like this isn't exactly like, you know, blue chip stuff. People buying Egypt making all-time highs. Again, evidence of accumulation, not distribution. So India, guys, I just got back from India. I mean, listen, I'm not going to be your fundamental analyst or anything like that. I'm just a humble technician. But man, you got to find a way to be long India somehow, some way over the next 10 years. You know, that place, oh my God, it's, you know, it's growing. The people are a lot of enthusiasm. There's a lot of them. Oh man, what a great culture. The food was amazing. Oh my God, find a way to get long exposure in India in the next decade. I think that's really interesting. But from a pure technical standpoint, you know, the fact that we are breaking out above these Fibonacci extensions, and guys, look how beautiful these extensions come into play. You know, so here we're looking at, notice how there's multiple extensions and they continue to come into play together. Again, resistance, then it turns into support, then resistance, and now we're through that. So I think we're going to 12,400 in the Nifty 50 here, and that's a long ways away. You know, further evidence we want to be in emerging markets. So EPI is a way that I like to play it. India, again, if we're above the 2011 highs here, right around 2860, if we're above that, we want to be long. I think we're going to 38. And then here's the Nifty 50 ETF, Indy, INDY, which I've liked for a while. The trade has been be long if we're above 33. I think we go to 42. You know, here we are above 39, so we're kind of in no man's land along the way. But I did want to point out that we're seeing the strength and money is moving in that direction. So here's a really interesting chart that I built. This is the indexes themselves for the BRICS, right? So Brazil, Russia, India, China, South Korea, and South Africa are the BRICS nations, and I equally weighted that basket, and then I overlaid it. I compared it to the S&P 500. So in other words, this is an equally weighted BRICS index relative to the S&P 500. And what I see is kind of like a major bottom, right? So I could totally see how this is like a bottom in the emerging markets, you know, relative to the S&P 500, which to me is further evidence that we want to be in emerging markets, because if they are going to start to outperform the S&P 500, you know, that's definitely an area that could do very well. Because think about it, if emerging markets are outperforming the S&P 500, that's probably happening in an environment where stocks are going up, not stocks are going down. Stocks are going down, in all likelihood, the riskier emerging markets would be dragging stocks lower, right? That's how I would look at that. So taking that theme one step further, right, and bear with me here, we're going to go through some charts right now and kind of walk you through the steps so you guys can kind of see the way that my mind works, right? So, okay, so now emerging markets are starting to bottom after Brazil is coming out of this monster base. That's really interesting. All right, and then the countries all together, the BRICS on a relative basis. All right, so now here we're looking at the currencies. So in the BRIC nations, the currencies are very highly tied to the stock market. So here are the currencies in a basket of the 5 of them, right? China, And then at the bottom is an equally weighted basket of base metals: copper, aluminum, zinc, lead, tin, nickel. And look, notice how they look exactly the same. So the fact that both of these are breaking out of, 7, 8 year downtrends, to me is evidence of really rotation into that theme of base metals and BRICS nations and emerging market stocks, right? There seems to be an ongoing theme here. So here's Malaysia breaking out of the downtrend line from 2014 to new highs, right? This is the Bursa Malaysia. So now here we're going to look at the Bursa Malaysia and then overlay crude oil. Notice how they look exactly the same. Malaysia has a lot of exposure to energy, as we know, but man, the stock market and crude oil look exactly the same. And look how Malaysia is just now breaking out. We just discussed this here. This is something that we want to be buying, not selling. And then you notice what crude oil is doing. As Malaysia is breaking out, crude oil is breaking out as well. So really further evidence that, we want to be in the energy space somehow, right? So what I did here was I took the crude oil futures and then I overlaid at the bottom an equally weighted index of the stocks that are most highly correlated with crude oil. So Australia, Brazil, Canada, Russia, and Malaysia. And what this equally weighted basket is doing is that it's breaking out of a 10-year base. You guys know how much I love 10-year bases. As they say, the bigger the base, the higher in space, right? So based on my Fibonacci work, I think we go to 131,000 in this particular index, which is still another, 20%-ish. And here, if that's going to continue higher, then in all likelihood, crude oil is going to continue higher as well. As you can see, a very high correlation between crude oil and the 5 countries together, an equally weighted basket of all of them. Let's take that one step further. Here we're looking at the 5 indexes, country indexes I just showed you, but now we're adding the Saudis too. So this is the TASI index, and this is up at the top. So this is the biggest 6 highly correlated countries, equally weighted, breaking out of a 10-year base. And then look down here, crude oil looks exactly the same, and I think continues higher. And to me, it's suggesting that crude oil is going to get into the 70s and probably even the 80s. So here's just Saudi Arabia on its own. Here's the TASI index. And, again, they look very similar. And I think the TASI is just now finishing this bottoming process, heading higher, and I think crude oil heads higher as well. So it's really a weight of the evidence sort of approach to come up with a thesis and then break it down into an individual stock idea or a series of them. Russia, another one who is very highly correlated with oil, just now the MICEX is breaking out after hitting our key extension. So notice how we hit the 161.8% extension of the 2011 to 2014 correction and literally pulled right back to that former resistance, rallied through there, and now we're off to the races. So the next level, in my opinion, is right around 2880, which would be the 161.8% extension of the entire decline from 2007 to 2009. So here we're looking at Russia, the exchange traded fund, the RSX, over crude oil. Again, they look exactly the same. So are you starting to see an interesting theme? Breakouts and things correlated with oil and oil continuing higher. I think they both continue higher together. So here's crude oil futures. I mean, the bottom line is we want to be long crude oil if we're above 63. Those are the highs from 2015. That had been our target for a long time. This was the 161.8% extension of this decline, right? And it was also the former highs from 2015. So that was a very logical target. We hit it, we consolidated, and now we're off to the races. So the trade is very simple. If we are above 63 in crude oil, we want to be long. I think we go to 76 and then ultimately 85. With that whole theme of breakouts in Russia and in Canada and in crude oil and in emerging markets, there's a theme of natural resources. And what do you know? Canada, the TSX, is now breaking out of a 10-year base. How many times? It's like a drinking game of this presentation. Every time JC says 10-year base, you take a swig. But it's the truth. I mean, how many monster bases do I need to call out? I mean, we've seen 20+ year bases also in Taiwan and Thailand and FTSE and things like that. But these 10-year bases, these things are huge. So I think Canada's going above 18,000. Here's a shorter term look. Here's the 2014 highs, 2015 highs, 2017 highs. Clear evidence of more selling than buying. There was clear overhead supply. This is not one of those things that is voodoo, This is not one of those things that is JC's opinion. This is fact that at 15,680, there were more sellers than buyers in Canadian equities. That is just pure fact. So the fact that we are above that is very clear evidence that the amount of demand has now been able to absorb all of that supply, finally, after 3.5 years or whatever it is. So the fact that we are above those levels, we want to be aggressively buying Canadian equities. We want to be investing in things that Canadian equities have exposure to, things like natural resources and energy and things like that. Notice how momentum hasn't gotten oversold in years. That is a characteristic of an uptrend, is a characteristic of a bull market, not a bear market. Same thing in Australia. Again, more evidence of countries with exposure to base metals and materials and mining and energy and natural resources breaking out a multi-year basis. I mean, this is an ongoing theme, and you can add Australia to that list of Singapore and Switzerland and Denmark, where we're saying, well, if this is not a real breakout and this fails, that would be evidence. That would be the first evidence of distribution that we're seeing, and we should probably, apply a more neutral approach or something like that. You know what I mean? But we haven't seen that. So I think Australia goes up. Here's crude oil relative to the S&P 500. So this is, okay, where do you want to be? Do you want to be in stocks or you want to be in oil? And to me, this looks more like a bottom than a top, doesn't it? And based on the weight of the evidence, to me, is suggesting that crude oil should be outperforming the S&P 500 moving forward, which makes sense with everything we've just seen, right? So here's the global Dow index. So instead of the just U.S., this is broken down into, it's diversified into more countries around the world, and we're just halfway to our target. You know, again, coming out of a 10-year base, and I think we're going to 3,900 in the global Dow index, and we're right around 3,300. So we got plenty of room to go. Here's the ACWI All Country World Index. Again, we hit our target of 7180. We consolidated for a few weeks, and now we're off to the races. And we're in no man's land right here around 77. I think we're going to 86. This is evidence that we want to be buying weakness in stocks, not selling strength. So this is the EFA, which is basically Japan and Europe for all intents and purposes. And we are now above those 2014 highs. So we've wanted to be long EFA. If we're above 71, I think we're going above 83, which is a long ways away. So again, if we want to be buying weakness in Japan and in Europe, then that, again, just not evidence of distribution. That is evidence that we want to be buying U.S. stocks also. We want to be buying stocks as an asset class. So here's the S&P 500, 2650 has been the level. The trade has essentially been, that was the target initially. Once we exceeded it, the trade has been, if we're above 2650 in the S&P 500, we want to be long. We want to be buying stocks. We want to be erring on the long and aggressively long side of the market. And I still think we're going above 3,000, probably closer to 3060 for now. And then we'll reevaluate when the time comes. New York Stock Exchange Composite is a great indicator. I know Bartoloni, Jim, we call him Bart, the intermarket musician. He mentioned the New York Stock Exchange Composite because he says it's more real. And I think what he's trying to say is that it is more diversified because it is a market cap weighted index. However, more than half of the largest 100 components are foreign companies, right, that have ADRs on the New York. So I think you're getting a more global sort of index, which is the reason it underperformed for a while the S&P 500 was ripping. But now we're off to the races. And, essentially the mentality has been if we're above 12,750, we need to err on the long side of equities, and I think we're going above 15,100 in the New York Stock Exchange Composite. So from a risk management standpoint, if we are below 12,750, that would not be evidence of a strong uptrend or a bull market. That would be evidence of distribution, and you could throw that one in there with Singapore and Switzerland, things like that. So here's just a closer look. I think we're going above 15,100. We want to be buying weakness in stocks, not selling strength. NASDAQ 100, I think we're going to 78.25, no question. The trade has been be long NASDAQ 100, either through Qs or futures or however makes, whatever it floats your boat. 63.30 has been the level. If we're above 63.30 in the NASDAQ 100, we want to be long with a target of 78.25. And by the way, if we're below 63.30, that's a problem. I'm not saying that's going to happen, nor has that not happened, but I think that would be a problem, and you can include that in more evidence that would suggest that we should be expecting something more severe. But I don't think that's going to happen. I think we're going to continue much higher. Here's the Russell 3000, another very important level, 1630 in the Russell 3000. If we are not above 1630 in the Russell 3000, I think that short-term risk is definitely here, and we don't know what's going to happen after that. But I definitely believe that if we are above 1630, we want to take this with all of the other evidence that we have seen that suggests we want to be buying stocks, not selling them. One of the most bullish charts to me, hands down, is the microcaps. You know, guys, this is the definition. These are the riskiest stocks, right? So if we are coming out of a multi-year base within an uptrend in the Russell Microcap Index, you know, that's characteristic of an uptrend. In a bull market, and I think we go to 127, we want to be buying weakness in IWC. So part of my travels and you know, experiences learning other markets. In India, they have this thing that they call the Nifty Next 50, where you know, they essentially take the Nifty 50, right, and then whatever the other 50 stocks that are in the Nifty 100 that aren't in the Nifty 50 is what they call the Nifty Next 50. So I'm like, well, that's cool. How come we don't have that, right? Because I saw like some signals in the Nifty markets that I saw in the Nifty Next 50 that I wasn't seeing in the Nifty 50. So I'm like, oh my God, this is great. And I was like all pissed because I was like, man, in America we don't have that. So I said, screw this. So I created my own. So I took the 50 stocks is the Dow Industrials and the Dow Transports, you know, 30 in the industrials, 20 in the transports. There's your 50. And then what I did was I took the next 30 industrial stocks by market capitalization, as well as the next 20 transportation stocks by market capitalization, to come up with the USA Next 50 index. And to me, this is just super bullish. I see, I mean, even in these indexes that I construct, you even see these Fibonacci extensions coming into play, form a resistance, turning into support right at a critical level, and now we're off to the races, and I think we go to 9,500. So if these next 50 stocks in America are going to continue to rally and with momentum in a bullish range, you know, that's a healthy environment. So one of the things that I always like to look at is what stocks are looking at on a relative basis. You know, if an asset class is in a bull market, it's going to be outperforming gold, it's going to be outperforming bonds, it's going to be outperforming the alternatives. Okay, so what we have here is the S&P 500 relative to U.S. Treasury bonds breaking out of a year-long base. Same thing, the S&P 500 relative to gold breaking out of a year-long base. So as long as this remains the case, we need to be, you know, erring on the very aggressively bullish side of equity. So we start to see some deterioration in these ratios. It's a heads up that something's wrong. One of the more interesting things that I like to do, I like to look at where the junkies are. What are the junkies doing? Like, what are the crazies doing? And that is really a function of the fact that I care more about the emotions of a market, the emotions of people, right? And where are emotions highest, where volatility is increased, particularly relative to other avenues where maybe more conservative investors are going to allocate their assets. So to me, if you're going to be in stocks, are you going to be in the S&P 500 and the Dow? No, you're going to be in the Russell 2000. If you're going to be in precious metals, are you going to be in gold? No, you're going to be in the crazy little one, silver, right? So the emotions are running high. They're in these more aggressive vehicles relative to their peers. So trying to figure out a stocks versus gold ratio is great. I think by looking at the Russell 2000 relative to silver and seeing, again, where the crazies are and what the crazies are doing, to me is really interesting. So the fact that we're breaking out of a multi-year base in Russell 2000 relative to silver, to me, is suggests risk appetite towards equities and you know, further evidence that we want to be buying weakness, not selling strength. So if we start to see this failing and, you know, silver start to outperform the Russell 2000, I think that would be a change in the dynamic of the market that we want to be paying attention to. So where within energy do we want to be? You know, I really think it's interesting what these natural gas stocks are doing, guys. And, you know, when I look at these patterns, people are like, oh, GC, technical analysis doesn't work because my head and shoulders didn't go down. Oh, my God. So, like, you get, like, all these ridiculous things. And to me, the fact that a pattern that is supposed to take place doesn't occur and actually does the exact opposite, to me, that's a signal in and of itself, right? It's not that technical analysis doesn't work. It's that your technical analysis didn't work, right? It's our job to reevaluate as the data comes in. So in this case, we're looking at natural gas in a very natural gas stocks, excuse me, not natural gas, the commodity, but an ETF of a basket of natural gas companies in Canada and Anadarko and the things like that. So we were in a very clear downtrend, nice, healthy, symmetrical triangle, which traditionally is very continuation in nature and should have continued and resolved in the direction of the underlying trend. However, it did not. It actually is resolving higher. So to me, if we're above 23 in the FCG, we need to be very long natural gas stocks. I think we can have another 50% upside in the natural gas stocks, which is really, really interesting. So moving over to the transportation, I mean, you know, speaking of Fibonacci's, you know, here we are just finding resistance right at this 161.8% extension of that entire 2014-2016 decline. So if we're above 11,150 in the Dow Jones Transportation Average, man, it's really, really hard to be bearish of equities. So I would argue one of the interesting things that you can throw in that risk management basket is transports being below 11,000. If transports are hanging out below 11,000, I think that would be evidence of perhaps some distribution to come. But if we're above 11,150, guys, I think we need to be I think we need to go higher, and I do think we go higher simply because of its components. One of the things that goes underrated when looking at markets, like, oh my God, the S&P 500, it can't go any higher. Well, if you just look at the individual components, of course it can go higher because the index itself, although we do trade that and it is tradable, it is a composite of all of the other things that are taking place all over the country and all over the world for that matter. So if you just take a look at what the stocks are doing, if the index was doing anything else than what it's doing, it would be very unusual, I would argue. So, you know, I love big bases, and I cannot lie here. Expeditors coming out of a, 12, 13-year base to making new highs. I think we go to 77. That's 10 points higher. We want to be buying weakness here. Look at Kirby. These are different stocks within the Dow Jones Transportation Average whose behavior is suggesting to me that the path of least resistance in transport stocks is still higher. Look at this multi-year base. Again, that word base, look at Kirby Corporation here, KEX. If we're above 75, we want to be long. I think we go to 93. UPS, look at this. Here's the high in 2004. Here's the low in 2009. Here's the retest of those former highs. Then we get the breakout, right? So the target becomes 120. So notice how we broke out. We didn't quite get there. We retested that former resistance, hit our upside objective of 120, pulled back up there again, pulled back, and now we are through that 120 level after the market has absorbed that overhead supply and digested those gains right at that Fibonacci extension level, which is where it should be doing that. So moving forward, we want to be long UPS if we're above 120. I think we go to 172. American Air, here the airlines, excuse me, not American Airlines, but airlines in America. Here's the index itself. I think we're going to 131. To me, this is still a big base, a successful retest, and I think we're off to the races. I think we're going to 131 in airlines. Delta's one we want to be buying here. We want to be buying this pullback. If we're above 53, we want to be long Delta. I think we go to 65. And then digging deeper within the transports to get an answer of, are transports going to go higher and lead this market to new highs, or are they going to roll over and diverge with the industrials and be the beginning of the end of this uptrend, right? So in order to answer that question, well, we can isolate certain levels within the Dow Jones Transportation Average, as we did right around that 11,150 level in the index. We are breaking it down to the individual stock components within the Dow Jones Transportation Average, and we are also breaking down within the sub-industries of transports, like railroads, like airlines, in this case, truckers. If the Dow Jones Trucking Index is above 820, I think we need to find a way to be long the truckers, the C.H. Robinsons, right, of the world. And then within transportation, I mean, all those transportation stocks essentially fall underneath the umbrella of industrials. I know it sounds counterintuitive, but yes, you have the Dow Jones Industrial Average and the Dow Jones Transportation Average, right? Those are indexes, but the industrials sector itself All of those transports are in the industrial sector. The XLI is the ETF that tracks that, and here we are exceeding that 261.8% extension near 76. So if we're above 76, we want to be long industrials. Momentum in a bullish range, breaking out above extensions. These are characteristics of uptrends. I think industrials go to 95, and that's another 20% away almost. So within that space, looking at a couple of railroads, again, within the Dow Jones Transportation Average, Kansas City Southern, to me, I still think it's going to 125, 126, which are the 2014 highs. We want to be buying any weakness if we're above 105. KSU is a long. I think we go to 125. Norfolk Southern also, notice how it is acknowledging this Fibonacci extension level right around 50 bucks. This is from the high in 2014 to the low in 2016. I think that this is going to be done consolidating very soon. And I think we go to 200 in Norfolk Southern. United Technologies, guys, I think this needs to be a buy. I think we're coming out of a multi-year base. There's that phrase again, these are smiley faces, not frowny faces. We want to continue to see these multi-year bases, these big smiley faces. And I think that that's what we're seeing here. United Technologies, the trade has been be long if we're above 124, target near 150. So we want to be buying pullbacks here for sure. Materials, if we're above 62, this is the XLB, which I believe is now up. You guys do the math, but it's something like 12 or 13 consecutive months positive, and materials just don't get the respect they deserve simply because they represent like 2% of the S&P 500 or something ridiculous like that. But why should we give a damn that it's only 2% of the S&P 500? We're just here to make money in the market, whether it's materials or healthcare or technology. We don't care if we're buying chemical stocks or tech stocks, right? It's just math and numbers and dollars in our pockets, and as long as we have disciplined risk management, right? So in the case of materials, ton of strength in a sector that rarely gets discussed. I think if we're above 62 in the XLB, we want to be long. So, and going a lot higher towards 78, which makes sense, makes perfect sense that materials are breaking out and we want to be long them if Canada's breaking out, if we like base metals, if we like precious metals. All of these things are in the material space. All of these countries with natural resource exposure are breaking out, and materials are leading the U.S. higher. They should be leading the U.S. higher. That makes perfect sense. So throw XLB in that risk management sort of basket, that if the XLB is below 62, it's probably a good idea that maybe we should really reevaluate this aggressively bullish stance that we have been maintaining in the equities market. But as long as we're above 62, I think we're going a lot higher, and I think the path of least resistance here is not just a little bit higher, but a lot higher. Here's the agribusiness. So these are the companies that are in the agricultural space, the stocks themselves, and I mean, just again, multi-year base, breakout, pretty standard stuff, momentum in a very well-defined bullish range. Notice how it hasn't gotten oversold in 2 years. These are characteristics of uptrends, guys. People are like, oh my God, this is a crazy market. We've never seen anything like this. Oh my God. Go pull up charts. This is perfectly normal breakouts, and we haven't even hit our targets yet. In MU, I think we're going to 68. Here's the chemicals index. This has been a huge winner for us for sure, especially since that breakout last year. We hit our target right here near 630. This is the S&P chemicals index. We hit that target. We consolidated as we should have, right? And then we broke out, and I think we're off to the races, and I think we got another 100 points left in the S&P chemicals index. And if we got 100 points in the S&P chemicals index, guess who's probably going to do well? And sure enough, here's Dow DuPont, which recently merged, and I think we're going to 88.5. Notice this monster 13-year base in Dow DuPont. Here's a closer look at that. So just from a shorter-term risk management standpoint, I think 72 is a good level. If we're above 72, DWDP is a very aggressive long in my book, and I think we're going to 87. Notice how momentum hasn't been oversold in a long time either. So if materials look good, if natural resources look good, if countries with natural resource exposure look good, then in all likelihood, the metals and the mining stocks should be looking good also, right? Emerging markets looking good. It's all a very similar theme in my work. And I still think we have another 10%. I think we get back to those 2014 highs in the XME above 44. So that's another 10% away. We want to be buying weakness, right? Not selling strength. Here's a really interesting one, particularly from a risk management standpoint in the material space, in the metal space. This is the Steel Index ETF, SLX. Notice how we're back up towards that 2014 high for the first time, really acknowledging it here, kind of hanging out now for a while. And man, if this starts getting above 51 and we're off to the races, man, I think that's another 40% of upside in the steel index. And think about what sort of stocks are doing well in that environment. I encourage you to go to, maybe Yahoo Finance or whatever your source is for ETFs and look at the individual components of SLX and what is driving this. I did that last week, so I highly encourage you to do the same. So if we're above 51, we want to be long SLX. I think we go to 72, but I think there's some individual components within that look good also. So this is a chart that's been brought up a few times, which I think makes me happy. These are smart guys. So the fact that I'm thinking in the same ways as some really smart presenters that I had here today, that's a good feeling. These are the smart dudes. So this is the broker dealers and exchanges index. Like I say, this is like the Mount Rushmore of ETFs around the world. I mean, this is broker dealers and exchanges. I mean, guys, this is like some of the most important companies in humankind. If these companies are crashing, we are in trouble. But that's not what's happening. We are breaking out of, here we said, say it all together, 10-year base, right? Breaking out of a 10-year base, monster base. How can we be bearish stocks if one of the most important sector ETFs on planet Earth is breaking out of a decade-long base? We can't. So I think we go to 86 in the IAI, and we want to be buying weakness, certainly not selling strength. So within that, right, there's that top-down approach. We like stocks, we like U.S. stocks, we like financials, we like broker dealers. Well, here's JP Morgan. If we're above 110, we want to be long JP Morgan. I think we go to 168. Look at Goldman Sachs, 10-year base, right? Again, just now breaking out above the highs from 2007. People are like, oh my God, JC, the market is so stretched and has gone too far, too fast. Goldman Sachs hasn't done a damn thing for 10 years. How can you possibly sit there and look at me with a straight face and tell me we've gone too far, too fast when one of the most important stocks on planet Earth is flat the past decade? I think we go a lot higher in Goldman Sachs. I think we're going to 376. We want to be long if we're above 250. American Express, multi-year base, just now breaking out. If we're above 95, we want to be long American Express. I think we go to 122. Berkshire Hathaway, I mean, this is the big mama of them all. So you talk about XLF. XLF is the financial sector. Berkshire Hathaway is the largest stock component of the XLF. So, this is, for all intents and purposes, we want to consider it a financial. It's not a Dow component, but it probably should be if it wasn't. It would be if it wasn't priced the way it is because of the silly price weighting of the Dow Jones Industrial Average. Not that I'm anyone to criticize anything that has to do with Charles Dow, because that is my dude. But the point is, Berkshire Hathaway is a very, very important stock. And notice how we hit that 261.8% extension, that $200 level, consolidated for a few weeks in a very, very tight range. Some might call it a bull flag, call it whatever you want, and off to the races. So I think we want to be buying weakness in Berkshire Hathaway. I think we go to 250, and that's further evidence that financials are going higher. And if financials are going higher, it's probably not happening in an environment where stocks are getting killed. You know what I'm saying? So here's Bank of America. If we're above 29.5, we want to be long. I think we go to 41. We want to be buying weakness in Bank of America, not selling strength. Same with Morgan Stanley. If we're above 53.5, we want to be long Morgan Stanley with a target above 73.5. Notice how this former resistance in 2015 turned into support in 2017. The next target was above 53. We hit that, we consolidated, and now we're off to the races. So that's our new level of risk management, 53.5. Do me a favor and throw Morgan Stanley in that list of stocks and indexes that we're looking at for risk management purposes. If we're above 53.5, we want to be long. I think we go to 73.5. So the consumer discretionary fund, I mean, you talk about the most important sectors in America, some of the most important gauges of consumer sentiment, behavior, and stock market, risk appetite for equities, all of these things. The fact that discretionaries are breaking through that 105 level, to me, suggests that it's going straight towards 121.5. We want to be long discretionaries if we're above 105. And by the way, if discretionaries start to fall below 105 and are hanging out below that, I would argue that's probably evidence of distribution. So a big one here is that the XLY stays above 105. Meanwhile, another one that was brought up a couple times is retailers. This is the equally weighted retailers, so not, you know, like Amazon represents half of it or anything like that. So this is the equally weighted retailers breaking out of what everybody except everybody seemed to say that it was a head and shoulders top. I argued the exact opposite last summer, and that proved to be very accurate. And I think that not only do we retest those 2015 highs, I think we exceed them. And if retailers are breaking out of a multi-year base, man, consumer discretionaries are probably going higher. Nike's probably something that we want to be buying. If we're above 68, we want to be long Nike. I think we go to 80. Meanwhile, the automobile fund here, Dow Jones Auto Fund here, multi-year base. I think if we break out and we start to see levels near 240, 245 in the automobiles index, I would argue that that's probably happening in an environment where consumer discretionary stocks, the XLY, continues higher like we discussed before, and that we're probably right on retailers heading up towards to new highs as well. All of those things are probably happening simultaneously. If we are going to be wrong in retail, we're going to be wrong in discretionaries, and I would argue that automobiles indexes are probably going to be below 220, probably hanging around down here, and this is going to fail. So a very interesting to watch from a risk management standpoint. Now, speaking of things that haven't done anything in 20 years, look at technology. Just now breaking out above those highs from 2000. You're going to be bearish the technology, and you're going to be bearish the stock market if the technology index fund is just now breaking out of an 18-year base. Come on. So what I think, or 17-year, whatever it is, you do the math, I think 18, whatever it is. So the point is, it's a long time. So if we're above 65.5, we want to be long XLK. I think we're going to 98, 100. So, you know, that is like another 50% away. So if technology outperforms here, technology keeps rocking, with these market caps, the stock market's going to keep going also. Look at the semiconductors. This is the SOX index. Those are the highs in 2000, right, March 2000. And we are trying to actually exceed those levels for the first time in 18 years, guys. 18 years. Texas Instruments just now breaking out above those 2000 highs. 18 years it took. 18 years. So now we're up. So how can we not be buying Texas Instruments if we're above 100? I think it goes up 50% from 100. So another, 40% from current levels. Cisco, I think we're going to 53. Monster, multi-decade base in Cisco. This looks beautiful. Momentum hasn't been oversold in 6, 7, 8 years. I think we're going to 53. Intel just broke out this week. If we're above 46, we want to be long. I think we go to 59. We want to be buying weakness very, 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 very aggressively in Intel. If we're above 46, we want to be extremely long Intel. I think we go to 59. Microsoft just now breaking out above the 161.8% extension of the 1999 really to the 2009 decline, and we're just now exceeding it. So the trade's simple. If we're above 87, we want to be long Microsoft. I think we go to 132. Verizon, nice little multi-year base here. It's not the sexiest name, but it pays a nice dividend. And if we are above 54, I think we can own it. I think it goes to 69.5. But if we're below that 54 level, it's probably messy. Biotechnology, here's the XBI just now breaking out above the 2015 highs. Anybody who knows me knows that I don't believe that new all-time highs are evidence of a downtrend. I am in the camp that if a stock or an index ETF or something is making a new all-time high, I would argue that those are things that we normally find in uptrends. So if we are above the 2015 highs, let's call it 91 bucks. If we're above 91, we got to be long biotech, guys. I mean, that's just what it is. I think we're going to 119 in the XBI. Here's a closer look. Here's that 91 level, which is the 261.8% Fibonacci extension of that 2014 correction, which I'm not surprised about. But again, if we're above 91, we want to be long. I think we go towards 120 in the XBI. Healthcare, so the fact that we like biotechs, it should be no surprise that healthcare is also breaking out of a multi-year base and just now exceeding the 161.8% extension of the 2015-2016 decline. So if we're above 86.5 in the XLV, we want to be long healthcare. We want to be long the space overall. whether it be through biotechs or a combination of both. I think we go to 101 on the XLV. UNH has really been the monster of them all. You know, 224 here seems to be the big level. If we're above 224, we want to be long. I think we go to 353. Momentum is in a very, very bullish range. You know, you want to talk about what buy-side institutions want to do. They are looking for relative strength, and they are looking for momentum. And UNH has a consistent, obnoxious amount of both at all times. So if you want to be where the institutions are going to be, you want to be in UNH. If you want to be screwing around with some crappy stock making new 52-week lows, looking for a mean reversion, then, you know, God help you. You're on your own. I'd rather be through, you know, with the institutions. Look at Pfizer within the healthcare space, coming out of, again, multi-year base in Pfizer. This is one of the biggest pieces of garbage in the market. It's done absolutely nothing. This stock did not get the memo that markets have been ripping for years, and this thing has just done absolutely nothing, disappointed all of its investors, in my opinion, creating tension, and therefore could spark it to go a lot higher. I think it goes to 41.5 for now, but it could certainly go higher than that. We want to be buying weakness and be long Pfizer if we're above 36.5. You know, one thing that was also discussed that I thought they did a great job, the presenters today, talking about what we've been seeing in utilities, a lot of that weakness. I think this chart really tells the story. This is the Dow Jones Industrial Average relative to the Dow Jones Utilities Index. And just notice the parabolic spike in industrials relative to utilities. So to me, suggest what? Keep buying stocks, keep selling bonds. I mean, that makes sense. So here what I did was I took the relative strength of the utilities and inversed it. So in other words, SPY relative to XLU. And so as the black line is rising, that's utilities underperforming the S&P 500. And then what normally happens is that the US 10-year yield tracks that very closely. Now, look at these two charts. I mean, if you took the labels out of both of these, you wouldn't be able to tell which one's which, right? They look exactly the same. So to me, this utilities underperformance, this parabolic utilities underperformance, to me is suggesting that interest rates are heading higher. Same thing with regional banks versus REITs. So if investors are not getting their yield in the fixed income market, they need to go to the stock market, right? So where do they get big yields? They get them in real estate investment trusts, REITs. You know, what about regional banks? Regional banks go up, you know, when the market thinks that interest rates are going up. So when you compare these two assets, they're very highly correlated with U.S. interest rates, particularly the 10-year yield. So if this ratio is going up, then in all likelihood, the U.S. 10-year yield is going to continue higher as well. And I do think that happens. I do think we go retest those 2008, 2009 highs. And I think that is going to be, you know, really a driving force for the U.S. 10-year yield. As you can see here, coming out of that downtrend line from those 2013 highs, nice base throughout last year, just now breaking out. So if we're above 2.6, you know, I think that we need to err on selling bonds. I think we go to 3% on the U.S. 10-year yield. Look at the 30s, you know, here putting in a nice base last year. If we're above, you know, 2.5, 2.6%, I think the next stop is 3.2. So that's a nice little area right there of risk management. And the leader's really been the shorter end of the curve. Look at the 5-year yields already making multi-year highs. I think that we're going to 3% on 5s. So if we're going to 3% on 5s, then, you know, maybe the long end of the curve is not going to keep up as fast and as quickly, but I do think that they're going higher. And of course, 2s, I think 2s get to 3% as well, just absolute beast, monster bottom. So clearly a lot more strength in the in closer end of the yield of the curve for U.S. Treasury bond yields, and less so towards the end. So, you know, I think that, you know, the TLT or just staying away from bonds altogether might be the best bet. Here, look at the futures market. Here, 10-year note futures really breaking down below this. So if we are below the 2013, 2014 lows, man, being short bonds just makes a whole lot of sense. And then here, look at the TLT. You know, if we're above that below that 123 level, I think a short position in the TLTs makes a lot of sense. And then here's just an inverse ETF for bonds. So a nice little bottom here. And, you know, if we're above 22, I think we could be long the TBF, which would make us short bonds or give us some sort of short bond exposure. I kind of like that now. And then, you know, it's not just U.S. interest rates going up. Look at Japanese 10-year yields. I think this is a nice base that resolves higher. Look at German 10-year yields. I think this also resolves higher, pushing up against those former highs in 2017. I think we go to 1% in German 10s. And then in the UK as well, you know, nice bottom throughout 2017, breaking out above the downtrend line from the 2014 high. So to me, the path of least resistance overall in the UK, in Germany, in Japan, in America is, to me, is suggesting higher levels. So we turn our attention to the precious metals market that theoretically in that environment should probably be doing well. And, you know, we're still not seeing the relative strength in silver compared to gold, which we really want to start to see. So while silver might be poking its head above some resistance, we really want to see silver outperforming gold as evidence of risk appetite for precious metals. Notice how they move in sync. So if precious metals are going up, again, remember, we want to see what the junkies are doing, right? The junkies aren't buying gold. That's for, you know, boring people. The junkies are buying silver. So we want to see silver outperforming gold as evidence of risk appetite for precious metals. So then here's the big question. Is this a situation? So here's the US dollar inverted, right? So if the line is falling, the US dollar is rising, right? So, and then here's gold futures. So is the question that this former support going to turn into resistance and this chart is going to fall, which means the dollar is going to rise and gold is going to break down and make new lows? Is that what's going to happen? Or is this a bottom in this chart, which will make it a top in the US dollar and a bottom in gold? Notice how they move very similar together to each other. So to me, it's becoming very clear that it's this one, this version, as opposed to this version. You know, I'm not seeing the dollar rolling over and I'm not seeing gold breaking downtrends. I'm seeing the opposite. I'm seeing gold making new highs and I'm seeing the US dollar making new lows. This chart's making new highs, right? 'Cause it's inverted. So I find that very, very interesting to see how high, you know, or how low the US dollar can go and therefore drive gold prices higher. Here we're looking at the Swiss franc, right? And it's very highly correlated to gold, as you can see here. And the Swiss franc has already broken out above the downtrend line from those highs in 2011, 2012. So the fact that gold is just now trying to break out, to me, that strength in Swissy is pointing towards further strength in gold. So I think we want to be buying Swissy. I think we want to be buying gold. And from a risk management standpoint, 1,300 has been my level. If we're above 1,300 in gold, we want to be long. And I think we're going to 1,530 in gold. What happens after that? Like, I'm not one of these guys that's going to be like, oh my God, gold's going to go to the moon. I'm not one of these guys. Like, I don't care if gold doubles or if it goes to zero. I couldn't care less. Our target is 1,530. When we get there, we'll reevaluate. It was very similar to crude oil. Our target had been 62.5 for a long time. Well, guess what? We got there. We reevaluated. Now we think it goes to 76. So when it comes to gold, we'll just reevaluate when the time comes. You know, silver, same thing. If we're above 17, we want to be long silver. I think we go to 27, which is a long ways away. And then what I did here is I took all the precious metals, gold, silver, and platinum, and I equally weighted, and I created essentially an equally weighted precious metals index. And not only did we not break down below that key support going back to 1999, but we're now breaking out above a nice little symmetrical triangle. So this is very, very interesting and is pointing towards buying precious metals. So here's Bitcoin. You know, we talk about these Fibonacci extensions and how important they are and how they come into play constantly. Here, just the nice 2013 highs, and then it crashed by 85, 89%, something like that. And then just notice, you know, resistance, support, resistance, support, resistance, support, just again and again, just literally kissing those levels and reversing. So what I think is happening here is we could potentially, notice how momentum has not gotten oversold in several years, about 2.5 years. So what I think potentially can happen is we start to get back above this 11,900, right? I think we could get a squeeze. So here's the look, right? This 11,900 is the key extension level, right? The 1109 extension level from those 2013 highs. If this is a failed breakdown below that, we can get a monster squeeze back towards not only 19,000, but really extend towards 30,000, right? But I think we only want to be long Bitcoin if we're above 11,900, and if we are, I think it's a straight shot to 30,000. Meanwhile, Ethereum is just consolidating really within this area. I think unless we're above 1,300, we don't want to be long. I think there's too much opportunity cost. I think the path of least resistance is still higher. This is still an uptrend, but I think that probably has some more consolidation left. We want to be long Ethereum if we're above 1,300. I think we go above 2,000. And if you guys are interested in the things that I had to say, and you like my presentation, and you like the way that my mind works and how I approach the marketplace, I encourage you, join us. We have a community of investment advisors, hedge fund managers, PMs, mutual funds, family offices, a lot of investment advisors. Buy the research because it makes sense. It's $1,300 for the year, or $1,297, whatever it is, and $400 a quarter. I mean, it's a no-brainer. And we're about to raise prices next week, guys. So, take advantage of the low prices. They're going to be risen forever starting next week. So go to allstarcharts.com/join, and you can start a risk-free trial for 30 days. So if it's not for you, we'll send you your money back. It's all good. So, guys, it's been 9.5 hours. 12 different presentations, and you guys asked great questions. The presenters were awesome. So I want to thank all of you for being here and taking time out of your Saturday to come to the 2nd annual Charts Summit. I know I certainly learned a lot. I appreciate all the feedback on Twitter and everything like that. I will be sharing all of the slides from all the presentations and all of the videos over the next couple of days. So just as long as you registered, you'll receive that. And just make sure you tell your friends to register so that they can receive it as well. And be sure to email me, jc@allstarcharts.com, if you have any questions or even just to say hi. Tweet it out, #ChartSummit. Let us know what you think. Tell the Twitter sphere what you learned here today. And, if you recommend that they watch the videos. So, again, #ChartSummit. Thanks, guys. I look forward to doing this again next year.